Hey everybody, welcome back to the channel. This is my breakdown of Palantir's earnings. I'm going to come out this video, try to keep it less than 15 minutes and sort of go through my thoughts, my analysis, the good stuff, the bad stuff that I saw in this earnings, and my overall macro level thesis going forward with this stock. So for anyone who has seen what's happened during earnings or seen sort of other people's coverage, this is my official video giving my thoughts, my analysis on Palantir. Now, Palantir earnings was, in my opinion, not horrible. It was not amazing. The problem is the macro is really bad. What do I mean by the macro? I mean the economy. The economy right now is not in a good situation. And there's a lot of reasons why the economy is not in a good situation, but there's two sort of fundamental reasons. Number one is interest rates are getting higher, and when interest rates get higher, the cost of borrowing capital becomes higher, which means valuations have to compress because of old companies are the value of their future cash flows, and it takes more money to borrow money to get those future cash flows, especially if you're a growth stock that's not going after profitability, but you're going after market share, then your valuations inherently have to compress because investors are paying more for you to grow as a company, which means they're going to pay less eventually because they can't keep paying more if it costs you more to make more money. So that's the first thing. Number two is inflation. Now, CPI reports are coming out tomorrow, and inflation actually might have a chance to grow at less of a rate that it's been growing before. It's still growing, but not as high as it was growing back in March. And if those numbers come out and they're decent, I don't think that's a catalyst to change the macro level economy, but I do think necessarily that is a at least decent sign that things are getting better. Inflation is still high. Interest rates are still bad. And then third, which is a video I made in January that a lot of people are forgetting about, we are in a midterm year. And I'm not saying there's no conspiracy that in a midterm year every year as it falls, but if you look at that video that I did a while back, the S&P on average falls around 15% during midterm years. And then it rebounds back the next year around 8%. So like whenever there's a midterm year, on top of the fact that we're coming off 2 years of a crazy bull run where the Fed pumped $7 trillion of liquidity into the market because we had a global pandemic and we didn't know what to do, all three of those factors, and when I say midterm year as a factor, I say it's this peculiar year where historically midterm years are bad, and on top of that, it's 2 years after a massive bull run, plus interest rates, plus inflation. You're going to have a bad economy. You're going to have valuations that compress. You're going to have something like ARK that was at 156, now at 47. It's going to just happen, or at 41 today, and it's going to be bad, which means growth stocks in particular are going to get hit. At the time of recording this video, SoFi's earnings apparently just leaked, and now it's like at $4.90. It's down 17%. It was already at $6, and it's like this was a stock that was $30. So same thing for something like a Palantir. The reason I'm spending some time, at least to be able to bring this up, is that the macro is bad, which means I think Palantir could have had a phenomenal earnings, and the macro still wouldn't reward it. Opendoor beat revenue by 500% year over year, and the market was like, cool. And they gave them like a 0.2% increase, and then they tanked them the next day. It's just the nature of how the market is. So I want to go through the actual numbers and talk a little bit about what they did and why I think overall they did decent for the economy and the environment that we are in, and some of the stuff I think they could have done better, or at least in terms of the presentation. So here's I just want to go through the financials, and then we'll talk about sort of the good and the bad. U.S. government driving long-term growth with 30%. U.S. government revenue CAGR from 2013 to 2021. So in Q1 2021, they had $208 million from the government. In Q1 2022, they increased 16% from the government to $241 million. Now, this is cool. The problem is there's a couple things they're leaving out. They're not explaining how many new governmental clients they got. And that's probably because it wasn't a lot. I did some digging, and they got 40 net new clients. If 37 of them are commercial, then 3 of them have to be governmental clients. If they got 3 new governmental clients, that's great. But that's fundamentally lower than the governmental clients they were getting all throughout 2020 and 2021, sort of proving this thesis that the government growth revenue is going up, but the clientele increase is not happening. And there might be a lot of reasons for that, and we'll see that over the next year what happens, especially with the Ukraine-Russia situation. They're probably going to be able to snag up some more clients, but that was one of those things I was like, I'm not sure why they're not showing that. And as a result of them not showing that, that was a little bad, in my opinion, for them to not show that. We ended Q1 2022 with net dollar retention of 124%. Q1 revenue grew by 31% year over year to $446 million. I thought that was actually really good. The fact that last year they did $341 million. This year, 31% more, $446 million. There's not that many companies that can replicate revenue growth 31%. Remember, they grew full year 2020 to 2021 41%, and they are still guiding for 30% compounded annualized growth, and we're going to talk about that later. So I thought this was actually a really good thing. Now, the problem here with net dollar retention is last year, their net dollar retention ended full year was 131%. So their net dollar retention actually went down. However, we still have a full year of 2022 to go through. So if the NDR goes up in other quarters sequentially, then their NDR will be similar, if not better than it was last year. But net dollar retention has gone down. Now, 124% NDR is still really good. It means you're getting a lot of value from your clients for every dollar you get. But still, that going down is not the best. Palantir needs to be growing at 40, 50, 60% for us to see the stock go insane to reach that inflection point, sort of Tesla of data type of numbers. I don't know when that's going to happen. I think it's a 5-10 year hold on the stock. And eventually when that does happen, because I believe it does have a chance to happen, then we're going to see it grow a lot more. Q1 U.S. commercial revenue grew 136% year over year, our 5th straight quarter of accelerating growth. I thought this was really good as well. The fact that they were able to get 136% more revenue out of U.S. commercial clients and 54% total commercial revenue growth. Again, 50%. We're hitting some of those 50, 60 types of numbers, which is really important. Last year, they made $133 million from their total commercial international revenue. This year, $205 million. That's a good thing. 54% growth. That is not easy to be able to do. Our total customer count grew 86% year over year. So we added 40 net new customers in Q1 2022 with total customers up 70% quarter over quarter. Now, this is a good thing. I think the problem is a lot of people are like, well, Snowflake has, 1,000 customers or blah, blah, blah has 1,000. So like, because a lot of companies do have a lot more customers and Palantir is getting, 40 in a quarter, it's like, all right, is that the most impressive in the world? Now, to me, that's impressive because the average size of the check they're getting from these customers is anywhere from 4 to 5 million, which is really good, right? Snowflake, you're just having a bunch of people just pay for an out-of-box service, and that might be a better business. The question is the value of that out-of-the-box service something that is sustaining for the long term? If you're betting on Palantir, you're betting that they have a unique value proposition that's fundamentally different. Commercial customer count. So they have 184 new commercial customers. They had 147 at the end of 2021, and the average revenue, as you can see, for the top 20 customers is about 45 million, whereas last quarter was 36 million. So they're up 24% in terms of the average revenue they get per the top 20 customers. Deals closed, 81 in Q1 2022, 208, 150%. Billings, they're going to collect 490 million versus 362 million, up 35%. I thought that was good as well. Now, deal value, this is another important thing. We ended Q1 2022 with 3.5 billion in remaining deal value, up 26% year over year. Remaining performance obligations grew 86% year over year to 1.2 billion. So that means they have about $3.5 billion more they can collect over 2.8 billion that they had last year, which shows 26% growth. That means they still have to collect this money. They've sort of secured these deals, but they haven't collected the money, meaning they have to perform the service. And performance obligations, these are like if they've reached these certain thresholds, they could get another up to $1.2 billion, which is good. All of this at the end of the day is a little bit, it's still skeptical because you don't know if they're going to fully lock in these deals and lock in these values. But if they are able to do that, then obviously that would be a good thing. Now, adjusted gross margins. Here is something I want to talk about. So their adjusted gross margins have been stable at 80%. That's phenomenal. That means for every dollar they make, they're keeping 80 cents of it, which is absolutely amazing. That's great. The problem is they are not showing their... Well, so we go to the next chart. They're not showing the chart of their adjusted operating margin. So in Q1 2022, adjusted operating income was 117 million, representing a margin of 26%. Now, last quarter, it was 29%, and it was going up. And they took away the chart from the past quarter that showed how it was going up because obviously it went down to 26%, which is not the best. Last quarter, it ended at 29%, which was decent. And I don't think this is the biggest thing in the world, but it does mean that the adjusted operating income margin was going down. Why is it going down? Because they're spending a lot more on sales and marketing and different expenses that they have because they have to grow the company. So when you grow the company, your adjusted operating margin, your total margin you make for all the revenue you get, it has to go lower, right? Because you just don't have the money to be able to include into that margin because you're spending that money. So that is going down. Now, is a 26% adjusted operating margin the worst in the world? No, if they hit scale, meaning if they have an 80% gross margin and they're able to get rid of some of the excessive costs that we'll talk about in a second, and they actually do have the 65% growth rate over the next 5, 6, 7 quarters, then that operating margin at 26% will likely probably go up to 30. And if it can hit 35 over the next 5, 6 years, then you're talking about a stock that's in a really, really unique ball place. And that's important as well. They ended with no debt, which is important, and their cash from adjusted cash flows went up as well. So, or was stable as well, 30 million and then 35 million. Now their guidance, Q2 2022, they're guiding a base case of 470 million in Q2 revenue. This was probably the worst thing that investors saw because they made that's only a 5% increase from the Q2 revenue from last year, which means it's not like that phenomenal, right? It's only a 5% increase from the Q1 revenue this year, which means there's not that much of a substantial increase in their actual revenue if you're only going to grow 5% quarter to quarter, right? Now, they're saying it's a base case. I think they put this sentence here. There's a wide range of potential upside above our base case, including those driven by our role in responding to developing geopolitical events. That, to me, is sandbagging. And they're like, hey, we're saying 470. We know expectations suck. We're probably going to deliver somewhere between 490, maybe 500. Let's see if they can do that. If they can do that, I think that's good to keep the guidance low. The problem is, in this market, if you issue that low guidance, your stock is going to get tanked. But in my opinion, I'm like, why would you issue high guidance? Because the market's going to tank you anyway. Now, this is another one. We expect second quarter adjusted operating margin of 20%. Notice right here, it's 26%. Now it's 20%. That means they're decreasing the adjusted operating margin by 6%. That's not good, but the reason they're doing that, obviously, is because they have to spend more on marketing and sales and things of that nature. So that was one of the things that was disappointing to me as well. But in a high-growth tech company, if their margins are going to decompress in order for them to be able to grow, that's something we kind of have to be able to expect as investors. Full year 2022, they expect full year adjusted operating margins of 27%. This was 29% last quarter. So again, that has decreased and makes sense, but 27% to me is not the worst in the world. This is one of those years that Palantir has to get through it. And then next year, if we can get higher to 30, 32%, that would be amazing. In the DCF I did with Sebastian, which is the investment banker I brought on my channel a couple months ago, if Palantir can grow at 36% year over year with 35% adjusted operating margins by 2030, it's a $250 stock. Now, those are hard numbers to get, but you see some of the stuff going from management saying that revenue growth of 30% for this year and the next 3 years, which is great. I mean, the fact that they're still saying, hey, we're going to increase revenue by 30% over this year and the next 3 years, I'm really happy with that. The question is, can the adjusted operating margins build up to that? And can they beat this 30% number? Because if they don't beat this 30% number to 40 to 50, you're not going to get that sort of Tesla of data type of argument that I think all of us, would love for Palantir to be able to get. So if we go to some of our numbers here, as you can see, stock-based compensation has decreased as well. So last year, 2021 is $193 million in the quarter. This year, it's 150. So that's a decrease of about 30%. That's good. That means stock-based compensation is decreasing. That is why GAAP profitability is getting higher. They were a negative 14% GAAP profitable last year at the end of 2021. Now they're negative 9%, which means they're closer to breaking even, which is also a great metric in my opinion, because, well, it's not even opinion. I mean, they have to break even in order to make a profit one day in order for the stock price to go up, right? Because you have to be profitable. And in order to get profitable, you've got to reduce these outstanding costs like stock-based compensation. Stock-based compensation going down 30% year over year, I think that's a good thing, because if you're not spending that much money on stock, which means you're not spending all the taxes and other logistical costs associated with that, you can put those things into other parts of your business and you can actually make the business more profitable because you don't have to spend all that money compensating your employees. So I think that was a good thing that we saw. Some of the other stuff we saw that was interesting here is that they did have some losses. Now the losses did get better. So for example, they lost $114 million last year. Now they lost $39 million in operations. They in sales and marketing, right? They spent $136 million. Now they spent $160 million. Research and development, $98 million, $88 million. So research and development went down. Not a crazy. I mean, it went down by $10 million. They still probably did a ton of R&D on different technical products and things of that nature. But nonetheless, that's good that it's going down. $146 million they spent 2021 general administrative. That's $142 million. Little small thing that's going down. Total operating expenses increased a lot, or a little bit more, mainly because of the sales and marketing. So I think sales and marketing was the big thing, right? If you're compensating your sales staff, if you're trying to give them high commissions to be able to get them to land those deals, that was probably one of the main things that mattered the most. Another thing that I wanted to show here that I thought was also really important to show, revenue, obviously 31% year-over-year growth. Right here is the EPS. Now, the EPS went down primarily because our SPACs that we've invested in, which is a controversial strategy, but I think it's a good strategy overall. I think it's going to be meaningfully and beneficial for Palantir if some of the SPACs play out, because it's going to pseudo-market their product in the first place. The SPACs are all being killed. Babylon Health, Wejo, Lilium, all these SPACs, which means if all these SPACs are being killed, especially their stock prices, Palantir is not going to benefit from that, right? They're getting about $30 million a year per quarter. They got $39 million this quarter from the SPACs. They're going to get $30 million in general. That's what they said on the shareholder call per quarter going forward. But the SPAC program is winding down. So if the SPACs and the stock prices are in the gutter for the SPACs, that means the EPS, the earnings per share for Palantir, is also going to be in the gutter as a result of all the investments we made being in the gutter. So until those SPACs go up, which means until the macro economy gets better, then Palantir's stock price is not going to, or EPS is not going to be beneficial as a result of all the investments we've made as well. So I think that's one thing to think about. Overall, I think this earnings was not the worst earnings in the world. I didn't like the presentation with Alex Karp in his philosophical ranting. I don't think it was bad. I did a full reaction to it. I just don't think it was phenomenal. I think it was a little bit like he was trying to get us to be like nuclear war, this, and that. And it's like, you're not putting up good numbers this quarter, not putting up horrible numbers, but not great numbers, which means, when people are asking you, hey, when are you going to be profitable? And you're just like skirting the question through this whole philosophical stuff. That's not the best in the world. Now, I did a reaction to that video and I understand the argument. And that's my point as a Palantir shareholder. That's a bit different. I'm not complaining that he ranted. I actually really understand why he made the arguments. What was the point of it? What was the analysis he was trying to give? However, I do think it was a little bit uncalled for in the beginning, especially when he got into a really, really deep, like technical rant about saying all these, interesting words that were very academic. It went over people's head at the end of the day. Look, if you believe in Palantir, you believe that they're a company that's solving problems, and those problems need to be solved by a company that is specific to the problems, that is built to solve those problems like them. Stock-based compensation went down. That's good. Governmental revenue went up. That's good. Governmental clients probably didn't go up. That's not the best. Revenue growth 31% year over year. That's phenomenal. The adjusted operating margin on top of that revenue went down. That's not phenomenal. I think this earnings was mixed in terms of there was a lot of good stuff that I liked just in terms of pure growth. And, they secured a $150 million deal with one of the Fortune 100 companies. All these little things that were in the earnings presentation that were awesome. But a lot of things also weren't included. And I think they didn't want to show those numbers because those numbers weren't the best. Now, it's not like those numbers mean you change your entire thesis on the stock. It's just that those numbers in this quarter, in the short term, aren't the best. But if you believe in the long-term vision that Palantir is building products to solve the biggest problems in the world, and that those products will be important, and that this is a rundown in which the macroeconomy sucks right now, which is why I spent a couple minutes talking about it in the beginning of this video, and things will get better and Palantir's products will be vital in those times when the macroeconomy is more friendlier to these growth stocks, then I think this is a stock to ultimately buy and hold. Ultimately, it's a question of, do you want to double down on your conviction and buy the dip, or do you not want to buy the dip? I just bought the dip at $10.80. I have 2,176 shares at a $19 average. I'm down a lot on the stock. I may be buying more at $7, $6, but I'm in no rush to buy the dip. I don't think anyone should be in a rush because the way this economy is going, I don't know if we have hit the bottom. I don't know if fear has started to fully capitulate. And ultimately, we're going to see in the next probably 3-4 months what happens with inflation, what happens with interest rates, and if the economy starts to normalize a market in this world that is ready to give Palantir, which is growing 31% year over year, the love that it deserves. And maybe it doesn't deserve that right now because valuations are compressed and because they're still not profitable. And I think if you give it 2-3 quarters and they get to profitability, stock-based compensation starts to go way down. They're growing maybe 45-50% year over year, and the products they're creating are having a mass appeal, then there is a world in which Palantir can obviously be very, very big. But those are my overall thoughts. What do you think about this quarter? How do you think it went? What do you think about the numbers? What do you think about some of the numbers they didn't include or that they included but that weren't the best? Would love to know all your thoughts in the comments. Let me know what you guys think, and I will see you guys in the next one. Bye-bye.